Hello guys, welcome back to our academy, and this is the last part of chapter 1 of the principles of auditing and assurance. Okay, and we are in the section 1.14 to the last session. Okay, and that is the chronology of an audit. We're starting with the chronology of an audit. What do we mean by chronology of an audit? We are referring to the step-by-step process, okay, of auditing a business, okay, auditing auditing in general. All right, so we have 8 stages, and with this stage we are starting with the first stage. This slides, okay, as usual we have 7 slides in this video. So this is the first slide, and the first slide contains 4 stages, okay, of the step-by-step process. And stage 1 is understanding the business. Okay, that's stage 1, understanding the business. And what is the objective of stage 1? The objective is to understand the business operations and record system on theoretical basis. This is what you should have in mind. Theoretical basis. That is to say, um, there is no valid fact about the the information that you have, but at least have an information of how the business work. Okay, of how the business works. So that is what the understanding the business. This is just asking questions, okay? Even if they lie to you, just ask questions and jot down. All right. So, and how is this being um how is this stage being achieved? Through interview, okay, of selected management staff. Okay, interview of selected management staff, background, ascertain background and nature of business and the records, refer to procedural manual and organizational charts, draft own system notes and draw system flow chart. So this is just to ask questions. How do you people who receive the payment, how do you record sales, who is in charge of this, who is in charge of that? Ask questions, okay? And also check the procedural manual and organizational charts. Then draft your own systems note and the flow chart of how business work based on the information that you were given. Okay, based on the information that you were given. Now we now proceed to stage 2, which is you now check the system in practice. Checking the system in practice. So if stage 1 is theory, remember, if stage 1 is theory, asking questions, okay, just putting it down. Stage 2 is practical reality. And what does that mean? The objective of stage 2 is to discover the operational system in practice. Okay? Operational system in practice. And how is that being achieved? You are to conduct selected walkthrough tests on typical transactions and your own observation based on what you can see. Okay? Stage 1 is what they tell you. Stage 2 is what you can see. Do you understand? What you can see, and yes, basically what you can see based on checking um, the system in practice. What is stage 3? Stage 3 is finding weaknesses. Okay, finding what? Weaknesses. That's stage 3. Stage 1, the same person receives payment. The same person who receives payment confirms confirms is also the one that issues receipts. So things like this, you actually check. That's stage 1. They told you this. Stage 1. Stage 2, you confirmed um by walkthrough. Okay, walkthrough test. and you see that, oh, what they told me is actually what is happening, then you find weakness. Okay, finding weakness is stage 3. And what does that mean? What's the objective of stage 3? To discover the strengths and weaknesses in the control systems in detail. Okay, and how is this being achieved? You are to complete all applicable sections of internal control evaluation questionnaire, that's ICEQ, internal control evaluation questionnaire, um, conduct compliance tests as necessary, and prepare memoranda on weak areas. What is the key idea here of stage 3? Auditor checks where problems can happen based on information you are given and the um the practical reality that you are seeing. Okay, if this person who receives money is also the one that issue receipts, that means this person could be, money could be, this could affect um the integrity of the financial statement. Okay, this could affect the um the record. Okay, integrity of the record. This could affect, so many things. The person can just be receiving money and, not issue receipt. Okay, that money is gone, it's out of the business, there is a leakage. So that is the weaknesses that an auditor is to check based on what he or she is being told and the reality. That's the stage 2, the practical reality of what he or she sees. You understand? So number 3 is finding the weaknesses and you understand what that means. Number 4 is evaluating weaknesses. And to evaluate the relative effect of weaknesses in the major operational area. That's the objective of evaluating weaknesses. What do we mean by evaluating weaknesses? Evaluating weaknesses means, is this weakness really material enough? What do we mean by material? I think I've explained materiality in so many ways. But what I'm trying to say is that, there are some weakness that does not um really really affect the financial statement. Let me give you an example. Same person who is cleaning, okay, is the same person opening the door for customers to enter the store. We are using a store as an example. There is a weakness, but is that material enough? That is what evaluating weaknesses is all about. Do you get it now? So the objective of stage 4 is to evaluate the relative effect of weaknesses in each major operational area. So how is this being achieved? Consider the effect of a weak areas with reference to materiality. And what do we mean by materiality? So, an error that is significant enough to distort the financial statement. Okay? To distort the financial statement. So consider the effect of weak areas with reference to materiality and any compensating control. I said compensation. Any compensating controls. That means, is there yes, this is a weakness, but this also balance the weakness. Do you understand what I'm trying to say? This also balance the weakness. So for example, I'm trying to find an example to explain compensating control. So what do we mean by compensating control? We are like, okay, let's say the same person, listen, the same, because if you go to a mall, okay, supermarket store, the person who receives your payment is the person who issues the receipt, okay, the cashier. Now, is that a weakness? It could be, if there is no compensating control. What is the compensating control? Compensating control is what keeps this thing in check, and that is the system. Okay, there is a system who that makes sure that, okay, what is being recorded, is being scanned. That's one. And you have a receipt to take to the security, who is to check if truly you have you have you know made payment and receipt has been issued to you, and also do some maybe sign or tear a part, to say that, okay, you have been cleared. Do you understand it now? And there is CCTV camera. So that those are compensating controls that balance, that makes that weakness not to be effective. Do you understand? So you are to consider the effect of weak areas with reference to materiality and any compensating controls. Number two, complete internal control evaluation schedule after total effect of weaknesses is noted. Okay, complete internal control evaluation schedule after total effect of weaknesses. So there's weakness A, there's weakness B, there's weakness C. So after the total effect of weaknesses is noted, you have to complete internal control evaluation schedule and report effects of major weaknesses to management. So what is the key idea in stage 4? Auditor decides how serious the weaknesses are and reports them. That's the idea of stage 4. So let's quickly have a quick summary. Now, stage 1 is to understand the business in theory, okay? Stage 2 is to check system in what? In practice. Stage 3 is to find weaknesses. And stage 4 is to evaluate what? Weaknesses. And if all of these are done in a like rightly, it gives you what? It makes the audit work, it gives the audit work a detailed, strong what? Strong base. Now let's move to the second slide. So this is the second slide, and in this second slide we'll be looking at the remaining 4 stages, which is stage 5 to stage 8. The first slide we looked at the first 4 stages, which is um you know understanding the business in theory, you know working work through um tests for practical reality of what is happening. Understanding the business in practice, understanding understanding the business in theory, understanding the business in practice. Finding weaknesses, that's stage 3, and stage 4, it is evaluating what weaknesses. So those 4 bases gives they have what they have their own importance. Okay, so that's like the first part. So this is the second part. This is now testing the records. We know the business. We know the business both in practice and in theory. Then we have find weaknesses based on the tests that has been conducted, and also evaluated the weaknesses to know the ones that are material enough. So to the work of the real work, which is testing the records. Now, the objective of testing the records is to confirm the reliability of the records as a basis for preparation of final account. I say financial, yes, financial statements. So what do we mean by preparation, reliability and preparation of financial final accounts? Before you have your trading profit or loss um account, you have other records, okay, that results to that, okay, that the information that you have in your financial statement are being extracted from. starting from the source document to subsidiary to ledger and the likes. Those are the records that add up to the financial statement that is being presented to the shareholders and the users, the final users. Now, there need to be a test on the records to determine if it is reliable enough for what we are seeing in the financial statement. Do you understand? So that is what stage 5 is all about. Checking the transactions. You said you sold 5,000 here. We are seeing 4,000. What happened? Do you understand? You said you sold 4,000 here, or you bought on the third day, but there is no evidence of transaction. There is no source document that backs that claim. Do you understand? So that is testing the records. That's what stage 5 is all about, testing the records. So how is this being achieved? You have to prepare a detailed audit program specifying the nature of substantive tests and the extent of tests of transactions and account balances. Execute the audit program by applying depth testing techniques. We are still coming to all of this in the coming you know um chapters. Okay, but what this is just talking about is conducting a substantive test on the records. So there is audit program based on what we have learned here. There is audit program. Okay, and what do we mean by audit program? Okay, this is what we are going to do, this is what we are going to do, this is what we are going to do, this is what we are going to do. Now there is substantive test based on the audit program. Okay, which result to reliability of what? Of records. Okay, confirm reliability of records. So the key idea here is that auditor now performs detailed tests on transactions and balances. They perform detailed tests on transactions and balances. Now let's move to stage 6, which is checking financial statement. Now we have checked the what um gave birth to the financial statement. So now let's check the financial statement. So what is the objective? The objective is to ensure that the draft financial statement are in agreement with the underlying records. Okay, to ensure that the draft financial statements are in agreement with the underlying what records. Okay, and how is this being achieved? Prepare a detailed year-end schedules. Okay, profit or loss and other comprehensive income schedules and statement of financial position schedules. We are still coming to that. Reconcile the movement of each item from previous statement of financial position to current statement. All of these are the activities that is being done in checking financial statements. So stage 6 is checking financial statements. Okay, so the key idea here is that auditor checks that final accounts match the records and previous year figures. Okay, they check that final accounts match the records and previous year figures. Now stage 7 is forming audit opinion. Now we know the business in theory, we know the business in practice. We have, based on what we saw, we found weaknesses and we've also evaluated the weaknesses. That's stage 4. Stage 5, we have, test the records and also the financial statement in stage 6. Now, stage 7 is now forming audit opinion. Okay, so what is the objective? The objective is to form an opinion as to whether the accounts give a true and fair view and comply with statutory and other requirements. Okay, to form an opinion as to whether the accounts give a true and fair view and comply with statutory and other requirements. And how is this being achieved? Um, Obtain letter of representation from chief executive. complete verification of assets and liabilities, execute financial position audit program, execute analytical review, consider effect of changes in accounting policy and events after the year end, use checklists to cover all disclosure requirements, post audit review of files, audit programs and accounts by independent partner. Okay, so all of these are you know being required before forming audit what? Audit opinion. Letter of representation, verify asset and liability, execute audit program, analytical review, change in policy, consider changes in policy and events after year end, use checklist for disclosures, post audit review by independent partner. All of these are required for for forming audit opinion. Now, stage 8, which is the last stage, is preparing audit report. So stage 8 is preparing what? Audit report. And we have formed audit opinion in stage 7. So we have to prepare audit reports. And the objective is to express opinion in the audit report to members. And how is this being achieved? Review draft content of director's report, consider the need for qualification, refer any qualification to what? To independent partners, draft final audit report for inclusion in the published accounts. Okay, that's annual report. You definitely see audit reports in the annual report. Okay, so review drafts. What is the key idea in stage 8? Final communication to shareholders through audit report. That's just what it means. You have formed audit opinion in stage 7. You have to report it. Okay, and that's what is being done in stage 8. Report to shareholders. Okay, so and with that, audit process is what is completed. Now we want to look at the phases of an audit. Okay, 5 major phases of an audit. That's what we want to look at in um the third slide. So the first phase is planning the audit. That's the first phase, planning the audit. And what is being done here? Auditor decides the work to do, how the work will be done, who will do each task, time and other resources needed. Okay, everything will be done in, that is, planning the audit. All of these questions will be asked, and the answers to them will be provided in the audit plan. Okay, so what to do, how to do it, who will do it, when to do it, all of these are questions that are answered in audit what? Planning. Now the key idea is that good planning saves time and makes the audit more effective. All right, so what is the phase 2 now? Phase 2 is understanding the business system. Okay, the business what? System. The business system. This stage 2 comprises both this phase 2 comprises both stage 1 and stage 2. Okay, auditor learns how business operates, studies how records are kept, understand how transactions are processed, look at internal controls. We said stage 1, stage 2. You know what? You know that stage 1 and stage 2 of the chronology falls under this understanding the business system as a whole. Okay, understand the business before you check the numbers. Okay, so stage 3 is gathering audit evidence. Gathering what? Audit evidence. Auditor collects proof and supporting documents, check accuracy and reliability, uses evidence to support findings. Examples of evidence: received invoice, bank statements, ledgers, all of this. And this is like checking the records. That's stage 5. Okay, stage 5 of the chronology. So the phase 4 is testing internal controls. Okay, auditor checks if controls are working well. finding out where errors and frauds can happen, perform tests on each controls. So this is like the stage 3 and stage 4. Okay, stage 3 and stage 4. Internal controls, checking approval before payment. Examples of control: approval before payment, different people do different jobs, regular checks and monitoring. All of these are done to check, to reduce mistake and what, and fraud. To reduce mistake and what, and fraud. And the last phase is reviewing final accounts. Okay, auditor reviews the final statement and carefully check if figures are correct and complete, decides if accounts give a true and fair view. So this is like stage 6. Okay, like stage 6. So give true and fair view. Final review helps auditor form his opinion, which is stage 7. Okay, and reporting it is stage what, stage 8. So simple flow of an audit. That is the phases. Plan the audit, that's phase 1. Understand the business, that's phase 2. Gather evidence, that's phase 3. Test controls, that's phase 4. Review accounts, that's phase 5. Give audit opinion, you know which is still um part of it. All right, so what you must remember: audit is a step-by-step process done carefully, not a one-day job. Each step leads to the final audit opinion, which is being reported to shareholders via audit report. So now we are moving to auditing and other assurance services, which is section 1.15, which is section 1.15. So auditors know a lot about how companies operate, because they have to know the business. Okay, how companies operate. They have to know the business. Knowing the business is part of their job. So because of this, clients may ask them to help with other services apart from auditing. So these services are referred to as other assurance services. Okay, and we have some couple of them, which is accounting services, that is helping clients keep proper accounting records, preparing financial statements for businesses, mainly for small firms and partnerships. Auditors helps you organize your accounts properly. Now, 2, taxation matters: preparing and agreeing tax returns, calculating tax reliefs and capital allowances, attending to tax office queries, handling objections and appeals, processing and getting tax clearance certificate for clients. Auditors helps with handling tax matters, okay, correctly. The third one is liquidation, receivership and trust, um, which means assisting companies to get the best returns on assets when the company is winding up. Okay, they want to sell off their assets. They help with um, getting the best returns on assets. Okay, acting as trustee to manage assets for order according to the trust deeds. You know, auditors help during winding up and act as a trustee. Okay. Number 4, advisory to companies seeking quotation on the Nigerian stock market. Okay, so a company that wants to go public, that is companies that want to list their shares on the Nigerian stock market, they help in the just all that is required. Auditor helps companies prepare for public listing. Number 5 is feasibility report, and that means to check if a business idea is practical and profitable. Okay, feasibility report. And this is because all of this is possible because the audit so many businesses, so they have ideas of how many industries work. How many industries work. If you one day want to go into uh having a conglomerate, having businesses in multiple industries, auditing, as an accountant, auditing is a good because you have information, you know how a lot of industries work, how a lot of businesses work. You know a lot about them. So that's number five. Number six is advice on staff pension schemes and likes. So, and last, you have secretarial services, filing of annual returns, registration and incorporation of new businesses, other CAC, and that's services for clients. Auditor helps with company registration and legal documents. Now, what you must remember is that auditors are not only checkers of accounts, they are advisors, planners, consultants, and problem solvers for many business matters. Okay, so that is what you must remember. Now, let's move on to slide 5, which is the agency theory and auditing. This is the part 1 of it, the agency theory and auditing. So, agents and principal. We need to understand that in agency theory, we have agent and we have principal. You have this in you have done this in business law, okay, law of agency. So there's a principal, which means the owner or a person who gives authority. That's what principal means. And there is agent, the person who works for the principal. That's the agent. Imagine all these landlord and agents. The agent is what, the one who brings the tenant, but the principal is the owner of the house. I'm just using that as an example. Okay, so principal is the owner or person who gives authority. The agent is the person who works for the principal. That's just a simple understanding of what agent and principal means. So principal gives authority, agent performs service on behalf of the principal. Simple example: shareholders is the principal to director. Directors are agents, okay? Because the directors work on behalf of the principal. They manage the assets on behalf of the shareholders, which is the principal, okay? Directors are principals for employees, okay? Because the employees work for the directors. The shareholders are also principal for the auditors, because the audit report is for the shareholders. Okay, the shareholders are the ones that requires the auditor to check the to check what the director has presented to them. Okay, to check the reliability of what the directors have presented to them. So the work of an auditor is for the shareholders. So that's why shareholders is the principal, and auditor is what, an agent for the principal. Now, even though the agent works for the principal, the agent also has his own interest to protect. Okay, that's the key idea. Now, managers, that's agents, may not always act exactly in shareholders' best interest, because they will ask, what is best for me? Okay, so they also look into that, what is best for me, because they have their own interest to protect. That's why the agency relationship conflict is eminent, is possible. Conflict happens when agent interest is different from principal's interest. So when the two does not align, there is what we call agency relationship conflict. Now let's look at example 1: directors and shareholders. Remember, the shareholders are the what, the principals, while the directors are the what, agents. So now, take a look at this example. Directors manage company's assets, but directors may want higher salaries and benefits. Now, what is the problem here? Higher director pay reduces company profit and assets. So shareholders want higher profits, more returns. Directors want higher pay, more benefits. You see that there is a conflict in the interest of both shareholders and the directors, that is the principal and the agent. Do you understand? So, auditors and directors now. Auditors report to shareholders, but directors often influence auditor reappointment. Now, what is the possible conflict here? Auditor may try to stay in good relationship with director, and also has the obligation to give true and fair view of what the director has prepared. So you see that there is conflict of interest in that relationship as well. So auditor and director, you know, because auditor wants to, there's pressure on the auditor to keep the directors happy as well, so that they can be what, reappointment. Now, what is the key idea here? The key idea is that agency conflict exists because different people have different interests. Principal needs safeguards and the money and monitoring to protect their interests. Audited accounts, internal control, regulations are examples of safeguards that is needed to make sure that uh, the interest, aligns together. Now, we now want to look at the application of agency theory to auditing. The big idea is that agency theory says conflict of interest can be managed so that agents act in the best interest of what? Of principals. That's what agency theory is now talking about. Agency theory says conflict of interest can be managed so that agents act in the best interest of principals. Shareholders need assurance that management is honest. Audited financial statements give that assurance. Trust increases and investment becomes easier. Audit protects shareholders' interest. Why management also wants audit? Good audit builds confidence in investors, banks, and the public. If shareholders do not trust the accounts, they will not invest. Therefore, management arrange for a proper audit which is in their own interest. What am I saying? The auditors and the agent, the director's interest is okay, higher pay. But they also know that if there is more investment, definitely they will get higher pay. And what can make investors to invest more is when there is what? There is there is an assurance on the financial statement prepared by them, that okay, what they have prepared is what is true and fair. So you see how agency theory, um the interest of the conflict of interest can be managed. So agency theory view: large companies have many shareholders. They need strong, high quality audits. They are willing to pay high fees for extensive and sophisticated audits. This convinces shareholders that management is honest and reliable. Now, owners and managers are usually the same people for small companies. They have fewer outside shareholders. They may feel strong audit is less necessary, so they may not pay high audit fee. That's for large companies and small companies and how they work. But the important point is this: even if shareholders are satisfied, other users still rely on the account. And when we say other users, we are referring to banks and lenders, we are referring to tax authorities, we are talking about suppliers, customers, and the public. So audited accounts are useful to many people, not just shareholders. Now, what are the simple understanding that we must remember? Agency theory explains why conflict happen in business. Conflict of interest, okay, happens in business. Audit is a tool to reduce conflict between owners and managers. Audited accounts increases trust and attract investment. Large companies need strong audits more than small companies. Audit is important for banks, lenders, and tax authorities too. Okay, good audit, more trust, better businesses. Better pay for everybody. What is the flow now? Owner gives authority, that's the principal. Agent, manager manage the business. There's conflict of interest which may arise, but there is a safeguard such as audited, account, and that gives trust, and that increases trust, and all users are what? Protected. Now to the last slide, which is the audit committee. What is an audit committee? An audit committee is a committee set up in public limited company. This is very important. You can only find audit committee in public limited company. And what they do is that they create space between directors and external auditors. Okay, so we have directors, we have external auditors, so we have audit committee in between, and there is a legal basis for this. Section 404 subsection 2 of CAMA 2020 state that every public limited company shall have an audit committee. So it is compulsory for public limited company, just as it is also compulsory for them to have an external auditor to audit their financial statement before it is being presented to the members. Okay, now membership of audit committee. Section 404 subsection 3 of CAMA 2020 state that the audit committee shall consist of 5 members, comprising 3 members who are shareholders representatives and 2 non-executive directors. The key idea: members must be independent and objective. They view the company's position in a detached and dispassionate manner. They act as a link between the main board and the external auditor. Now, what are the functions and responsibilities of an audit committee? Okay, section 404 subsection 7 of CAMA 2020 state that the objectives and functions of the audit committee are to: 1. Ascertain whether the accounting and reporting policies of the company are in accordance with legal requirements and agreed with ethical practices. That's 1. 2. Review the scope and planning of audit requirements. 3. Review the findings on management matters in conjunction with the external auditor and departmental responses thereon. So when we say, okay, finding weaknesses, evaluating weaknesses, there's a report of those weaknesses. It is being reported to what? To the audit committee, which is then conveyed to the directors. Okay, and um so many other things that is to now go on from there. Number 4 is to keep under review the effectiveness of the company system of accounting and internal control. All right. 5. Make recommendations to the board with regards to the appointment, removal, and remuneration of external auditors. So appointment, removal, the salary, the remuneration of the external auditors is a core responsibility and function of audit committee. And lastly, authorize the internal auditor to carry out investigations into any activities of the company which may be of interest or concern to the committee. So simple understanding: audit committee helps to ensure transparency. What do we mean by transparency? I need to quickly explain. You see that we have 5 members in the audit committee. 3 are shareholders representative, and 2 are non-executive what directors. So that means we have people from shareholders and we have people from the directors. So you cannot say it is in favor. I think they just want to remove me as director. That's why they colluded with the external auditor to do what they did. And yes, you have so that's why there is both the director from the agent side and from the principal side coming together to form the audit what committee for transparency sake. It's not as if directors are not involved and shareholders are not even involved at all. So it helps to ensure transparency, accountability, and good corporate governance. It improves transparency, strengthens internal control, reduces management influence on auditors, improve audit independence, protect shareholders' interest. What you must remember is that PLC, that's public limited company, must have audit committees, a must for them. Committee has 5 members. It links board and direct and auditors together. It reviews accounting and audit matters, it monitors internal control, and it improves independence and protects shareholders' interest. So that's all that we have for chapter 1, part 3 of chapter 1. So if you find this meaningful, please like, share, and subscribe. And I'll see you in the next video.